In this video, I'm going to show you how to calculate a company's price-to-book ratio. The price-to-book ratio, which is also known as the market-to-book ratio, measures the company's market value relative to its book value. And there are two different ways that you can calculate the price-to-book ratio. In the first method, you could take a company's stock price, which is ultimately the company's market value expressed on a per-share basis, and divide it by the book value per share. Alternatively, you could take a company's market capitalization and divide it by the total book value. Okay, so either way, you're going to end up with the same price to book ratio, so you can use either method. Now, if you're a little hazy on the concept of market capitalization, just remember that it's a company's stock price multiplied by the number of common shares outstanding. So it's the market value of the company's common equity. Now, what do we mean by book value? Well, when most people talk about the price to book ratio and they're talking about the book value, they're talking about the tangible book value. Okay, so that's the book value of the company, excluding intangible assets like goodwill. So again, to get the tangible book value, you take a company's stockholders' equity, and that's ignoring any equity that's attributable to non-controlling interests. Okay, so you just take that company's equity, and then you subtract any preferred equity if the company has preferred stock that they've issued, and then you subtract the intangible assets like goodwill. So that's the tangible book value we're talking about here. And if you want to know that book value on a per share basis, you just take that tangible book value, divide it by the number of common shares outstanding. Okay, so when I say book value per share, I'm talking about tangible book value per share. And when I say book value, I'm talking about tangible book value. And I'm going to show you how to calculate this. So let's do an example with JP Morgan Chase and Citigroup. So I got some numbers. I went to their balance sheets as of December 31st, 2020. And I've got the stockholders' equity for each company. So you see JP Morgan Chase, it's a little over $279 billion because these amounts are in millions. And Citigroup, a little over $199 billion of stockholders' equity. Now, to get the tangible book value, we subtract preferred equity, we subtract goodwill, and we subtract other intangible assets. We subtract all those things from the stockholders' equity. Okay, that gives us the tangible book value. Now, if we divide that by the number of common shares outstanding, we get the book value on a per share basis. So we've got here our tangible book value per share. So that's this number here divided by this number here is this number here. Okay, now I went and looked up the stock price. Okay, looked up the stock price of each of these companies so that we could then calculate the price to book ratio. So let's do JP Morgan Chase first. We take the stock price, which was a little over $127, okay, as of December 31st, 2020. We divide that by the book value per share, we get 1.95. Now, if you were to do the same or if you were to instead do the other method that I talked about, where you take the market cap and you divide it by the tangible book value, so this number divided by this, you also get 1.95. So again, whichever method you use, you're going to end up with the same price to book ratio. Now, how do we interpret this? Well, let's look at Citigroup. Okay, when we look at Citigroup and we divide the stock price by the book value per share, we actually get a number that is less than 1. It's 0.84. So it's much lower, okay, than the price to book ratio for JP Morgan Chase. So how do we interpret this? Well, value investors, what they're really looking for is a low price to book ratio. Okay, that indicates that a company might be a bargain, particularly when the price to book ratio is less than 1. Why might that be the case? Well, let's think about it. The stock price as of this date for Citigroup, December 31st, 2020, is a little over $61 a share. Okay, so $61 to buy one share, but the tangible book value per share was over $73 per share. Okay, so the tangible book value, what is that even telling us? When we're talking about this tangible book value or expressed on a per share or total basis, what we're talking about is we're thinking about the accounting value of the company. Okay, so the accounting value is over $73 a share, but the actual stock price is just $61 a share. So if you are a value investor and you see this price to book ratio of less than 1, that would indicate to you that Citigroup is trading at a bargain. It's a discount. You can buy a share for a little over $61 and get something that has an accounting value that is over $73. Now, of course, the accounting value is not necessarily the intrinsic value of one share of Citigroup, but if you're a value investor, this is something that you look at. You look for companies that have a price to book ratio of less than 1.